Hey there, this is Mindy Strong. This video is going to help you understand the large concepts in the money market debt section if you are preparing for the Series 65. I hope this helps. Money market debt. See what I did there? All right, here we go. This is going to be short. So, first of all, let's look at the definition of a money market instrument. It's a debt obligation which matures in 1 year or less. That means it is very liquid, it is very safe, and because it's very safe, we can expect lower yields. Typically, these trade in huge amounts of money. We're talking $1 million to $5 million between institutions. There is also something called capital market, which is a debt obligation which matures in more than 1 year. Now, the money market instruments are issued at a discount and they mature at par, and we expect that because they are short, they are 1 year or less. But sometimes they can be issued at par and earn accrued interest, which is spelled wrong. Accrued, that was just to see if you're paying attention. And yes, you're right, it was spelled wrong. Okay. This section is really here to talk to you about open market operations. You can expect to see some questions on this. Let's understand the concept. We are not memorizing, we're learning concepts. Okay, so first of all, what are open market operations? They are the buying and selling of money market instruments with bank dealers by the Federal Reserve. When the Federal Reserve buys money market instruments, the banks get money to lend out, and this increases credit availability. When the Federal Reserve sells money market instruments, the bank loses money to lend out. Oh, this tightens credit. Okay, so before I go on to the next slide, let's talk about what this means. So the Federal Reserve is in charge of making sure that we don't go into a crazy period of inflation and we don't go into a recession. So they control the amount of money the banks have to lend out. The way they do this is by either buying a money market instrument from the banks or selling money market instruments. So let's think logically, if the Federal Reserve buys a money market instrument from a bank, they are giving that bank more cash, right? More money. When the bank has more money, it has more money to lend out because there are rules as to how much of a bank's money they can lend out and how much they have to hold on to. So then the opposite. Let's say that the Federal Reserve is fearing inflation and prices are going to go crazy. So they can sell money market instruments to the banks, which is going to take money out of the bank, right? Because the bank has to pay for the money market instrument. So it drains the bank of those funds. So they can't lend out as much money. Cool, makes sense. Okay, this slide is a little crazy, but stay with me and we'll get through it together. Let's look at the types of money market instruments. The T-bills are the largest money market instrument. Commercial paper is the short one, and we've talked about that before. Those are 270 days max. Usually they're around 30 days. Any treasury security maturing in less than 1 year is considered to be a money market instrument because it falls under that definition of less than 1 year. Duh, makes sense. Cool, not going to overthink it. Bankers' acceptance. These are used to finance imports and exports. They trade at a discount and there is a thin trading market. Bankers' acceptance. Now, we have heard of traditional CDs. We know how they work. However, negotiable CDs are a little bit different. They are jumbo CDs that are repaid in 1 to 3 months, not years, 1 to 3 months. And they can be traded in the secondary market. They can be traded in the secondary market. So you don't have to hold on to them for the entire 1 to 3 months. The FDIC covers these up to $250,000, and interest rates greatly affect these. Negotiable certificates of deposit. Negotiable, so they can be traded, right? So it's in the word there. So if you're asked, can negotiable certificates of deposit be traded? You're going to be able to say, duh, negotiated. Absolutely, they can be traded. Okay, now I sort of touched on this, but let's go ahead and look at the other terminology associated with the Federal Reserve buying and selling money market instruments. So repurchase agreements are when the Federal Reserve buys a money market instrument from a bank. So that infuses money into the bank. So they buy paper from the bank, the money market instrument, and they promise to repurchase later. So again, this is buying something from the bank. So they are giving money to the bank, which is going to give the bank more money, which is going to loosen credit. So the bank is able to give out more loans, and the federal funds rate is going to go down. The opposite is a reverse repurchase agreement. This is going to drain money from the bank. The Federal Reserve sells back that paper to the banks. So the bank has to buy it back, give the money back to the Federal Reserve. That takes money out of the bank. They're going to have less money to lend. This is going to tighten credit, and the federal funds rate will go up. Okay? Repurchase agreement gives money to the banks, loosens credit, federal fund rate goes down. Reverse repurchase agreement is going to drain money from the bank, tightening of credit, and the federal fund rate is going to go up. Here is just a visual to help you. Repos are going to loosen credit, infusing money into the banks. Reverse repos are also called matched sales. And it's going to tighten credit. It's going to take away from the amount of money the bank has to lend out. Federal funds, I talked about them a little bit. They are the shortest term money market instrument. Reserves are held on deposits. They're overnight loans between member banks, and they have extremely volatile interest rates. Okay, they're reserves held on deposits, and they're just overnight loans between member banks. So obviously they're the shortest term because they're literally overnight, while you and I are sleeping. Okay, last slide in this section. This is a short section. Money market mutual fund. So this is a managed portfolio. However, there is a low management fee or fees assigned. It is issued by the fund itself, and it can be redeemed at any time. We know about mutual funds. We've learned about mutual funds. So basically, you can buy them and redeem them. The price goes up, then you can redeem them, make some money on them. Mutual funds. So they're not traded, they're redeemed. Okay? Cool. That's it, y'all. Quick section. Money market instruments. Hope this has been helpful. Let me know if it has. Have a great day.